China, the world's second-largest economy, is facing one of its most significant economic challenges in recent history. In response, the Chinese government has rolled out a massive stimulus package to jumpstart growth and stabilize key sectors like real estate and the stock market. But with global attention on China's next moves, the question remains: will these unprecedented efforts be enough to save the economy, or is China headed toward a deeper economic crisis? Today, we're diving into the heart of China's economic rescue mission and what it means for the global economy. Chapter 1: The Massive Stimulus Package and Interest Rate Reductions. China's central bank recently launched its largest stimulus package in years, a clear signal that the government is pulling out all the stops to reverse the country's economic slowdown. This move involves an unprecedented injection of liquidity aimed at stabilizing various sectors, including real estate, the stock market, and consumer lending. The boldness of this stimulus package showcases China's serious concerns about the long-term health of its economy, and the world is watching closely to see if these efforts will pay off. A central part of this strategy includes significant interest rate cuts across the board. By reducing the cost of short-term loans and mortgages, the Chinese government is hoping to provide much-needed relief to households and businesses alike. These rate reductions, which have brought borrowing costs to historically low levels, are designed to stimulate investment and spending. The hope is that this will kickstart growth, but some experts are questioning whether these measures will be enough to reverse the tide. The Chinese real estate market, a long-standing pillar of the country's economic growth, has been one of the hardest hit sectors. Despite the stimulus, property prices continue to fall, leaving both investors and potential home. Many fear that the government's moves, while bold, may not be enough to stabilize the market in the long run. After all, real estate has been over-leveraged for years, and this correction may be just the beginning of a larger shift. Additionally, the stock market, which initially reacted positively to the news of the stimulus package, is showing signs of uncertainty. While some companies have seen short-term gains, the broader market remains cautious. Investors are unsure if these gains are sustainable or just a temporary bump in the face of deeper economic issues. The performance of China's stock market will be a critical indicator of the long-term success of the stimulus efforts. Across the board, there are clear signs that the Chinese economy is decelerating. From sluggish credit growth to a decline in private investment, it's evident that the challenges facing China are deep-rooted. While the government's aggressive measures aim to counteract these trends, there are no guarantees that this will lead to a full economic recovery. Finally, it's important to consider how this massive stimulus and interest rate reduction will affect global markets. Given China's position as a major economic player, its financial decisions have ripple effects worldwide. Countries like Brazil, which are heavily dependent on exporting commodities to China, are watching closely. A prolonged slowdown in China could mean reduced demand for materials like steel and iron ore, triggering a global economic shift. Chapter 2: Real estate struggles and economic slowdown. Despite the sweeping measures introduced by the Chinese government, the real estate market remains under intense pressure. Property prices, which have been on a downward trajectory for months, continue to plummet, leaving homeowners and investors scrambling. This sharp decline is more than just a symptom of a cooling market. It reflects deeper structural issues within China's real estate sector, which has long been over-leveraged and heavily reliant on speculative investments. For years, the property market has been a significant engine of economic growth, but now that engine is stalling. The government stimulus package, aimed at providing relief through mortgage rate cuts and financial support for developers, has yet to reverse the damage. Many developers are still grappling with massive debts, and ongoing construction projects are being delayed or abandoned altogether. This uncertainty is leaving prospective homebuyers hesitant to invest, further weakening demand. The drop in housing prices is also causing a ripple effect, as lower property values reduce consumer wealth and erode confidence, making it even harder to reignite the market. At the heart of the crisis is the imbalance between supply and demand. China's rapid urbanization over the past few decades fueled a construction boom that outpaced real demand. Developers built lavish apartment complexes, often in less desirable locations, banking on future buyers. Now, as demand falters and prices drop, many of these properties are left vacant or unsold. This glut of unoccupied real estate is a stark reminder of the challenges facing the sector and raises questions about how long the government can sustain its intervention. The economic slowdown, meanwhile, is not confined to real estate. Across various sectors, China is experiencing a marked decline in growth. Indicators such as credit expansion, consumer spending, and industrial production are all showing signs of stagnation. While the economy has not officially entered a recession, the deceleration is undeniable. This slowdown has not only shaken domestic markets, but is also raising alarms globally, as China's economy is deeply interconnected with other major ECA. A critical factor contributing to the slowdown is reduced demand in the construction and manufacturing industries. The construction sector, once the backbone of China's rapid growth, is no longer driving the same levels of economic activity. With fewer new projects breaking ground and existing developments stalling, demand for key materials like steel and concrete has plummeted. This decrease in infrastructure investment is sending shockwaves through the broader economy, affecting everything for decades. As the construction sector contracts, the effects are being felt beyond China's borders. Countries that rely heavily on exporting raw materials to China, such as Brazil and Australia, are seeing reduced demand for their commodities. This is causing ripple effects in global commodity markets, with prices dropping and concerns growing about a prolonged slump in demand. Chapter 3: Stock Market Reactions and Long-Term Concerns. The initial reaction from the Chinese stock market to the stimulus package. Investors welcomed the government's bold actions, and many companies saw their share prices rise as a result. In the short term, this seemed like a positive sign, sparking hope that the market could recover from its recent slump. However, the enthusiasm didn't last long. As the initial excitement faded, doubts about the sustainability of these gains began to surface. One key concern is whether the stimulus measures are merely providing a temporary boost, rather than addressing the root causes of The stock market has long been seen as a barometer for the health of the broader economy. And while there was an uptick in trading activity, experts remain cautious. Many companies, particularly in sectors like real estate and construction, are still facing significant financial difficulties, raising questions about their long-term viability. There is also growing uncertainty about the future trajectory of China's stock market, especially given the ongoing economic slowdown. While some companies have managed to post short-term gains, many others are still struggling with reduced demand, rising costs, and declining profitability. The performance of these firms will be a critical factor in determining whether the stock market can sustain its recovery or if it will face another round of volatility in the near future. In particular, investors are closely watching the technology and financial sectors, which have been underperforming for some time. Despite the government's efforts to stabilize these industries through stimulus measures, the underlying issues, such as regulatory crackdowns and slowing consumer spending, have not been fully resolved. This creates a sense of uncertainty for both domestic and foreign investors, who are hesitant to make significant moves without clearer signs of long-term stability. Furthermore, the Chinese government has a history of intervening in the stock market, which can create additional unpredictabilities. While these interventions are often aimed at preventing panic selling and stabilizing prices, they can also lead to artificial market distortions. This raises the question of how much of the recent gains are truly organic, and how much are the result of government efforts to prop up the market. In the end, the long-term success of the stock market will largely depend on the broader economic recovery. If China's stimulus measures fail to address the deeper economic problems, such as the real estate crisis and slowing industrial production, the stock market could see a prolonged period of stagnation. This would have significant consequences not only for domestic investors, but also for global markets that are closely tied to China's economic performance. Chapter 4: Reduced steel demand and the construction slowdown. One of the most telling signs of China's economic deceleration is the sharp DCL. Once a key driver of China's meteoric growth, the construction sector is now facing a significant downturn, resulting in a major drop in the need for raw materials like steel. This slowdown is particularly concerning because construction has long been one of the pillars of China's economy, fueling job creation, urban expansion, and infrastructure development. As demand for steel falls, it signals a broader slowdown in industrial activity and economic growth. For years, China's insatiable appetite. The country was responsible for more than half of the world's steel consumption, largely due to its massive infrastructure and real estate projects. However, as new construction projects dwindle and ongoing developments stall, the demand for steel has plummeted. This decline is a clear indication that the construction boom that once propelled China's growth is now losing steam. One of the key reasons behind the reduced demand is the slowdown in property development. As the real estate sector grapples with oversupply and declining prices, developers are hesitant to embark on new projects. This has resulted in fewer contracts for construction companies, which in turn has diminished the need for steel and other building materials. Even government-funded infrastructure projects, which have been a lifeline for the construction industry in previous downturns, are not enough to offset the steep decline in private sector investment. Another contributing factor to the decreased steel demand is the reduced level of infrastructure spending. During the height of China's growth, massive investments in roads, bridges, railways, and other infrastructure projects were common. However, in the current economic climate, the government is being more cautious with its spending, particularly on large-scale projects that may no longer deliver the returns they once did. With less money being poured into infrastructure, the demand for steel, the implications of reduced steel demand extend beyond China's borders. Major steel exporting countries such as Australia and India have been heavily reliant on Chinese demand to drive their own economies. As China reduces its imports of steel-related commodities like iron ore, these countries are feeling the strain. This is causing ripple effects in global commodity markets, with prices dropping and concerns growing about a prolonged slump in demand. The construction slowdown, coupled with the decline in steel demand, represents a significant challenge for China's economic recovery. As one of the largest sectors of the economy, construction's troubles are a reflection of broader issues that cannot be easily fixed by short-term stimulus measures. Without a resurgence in building activity and infrastructure investment, China's path to recovery will be much more difficult than anticipated. Chapter 5: Inflation, Deflation, and Consumer Confidence. Another critical issue facing the Chinese economy is the unusual mix of low inflation and deflationary trends, which is further complicating recovery efforts. With inflation rates hovering around 0%, some sectors are even experiencing deflation, where prices are dropping rather than rising. This deflationary pressure is a clear indicator of weakening demand across the economy, particularly in consumer goods and services. While low inflation may seem beneficial for consumers at first glance, in reality, it often signals deeper problems in the economy, including a lack of confidence in spending and investing. Deflation can have serious consequences, especially in an economy as large as China's. When prices fall, consumers and businesses tend to delay purchases in the hope that prices will drop even further. This creates a vicious cycle where spending slows, businesses reduce production, and prices continue to decay. The end result is stagnation, where economic growth grinds to a halt and recovery becomes increasingly difficult to achieve. China's current deflationary pressures are particularly concerning given the already sluggish economic environment. In the real estate sector, deflation is contributing to a further erosion of consumer confidence. As property prices continue to fall, potential homebuyers are hesitant to invest, fearing that prices could drop even more in the future. This lack of confidence is feeding into the broader economic slowdown, as the real estate market has long been a cornerstone of consumer wealth and spending in China. When property values decline, so does the wealth effect, leaving households with less disposable income and less willingness to make big-ticket purchases. The Chinese government is keenly aware of these risks and has been attempting to combat deflation by injecting liquidity into the market and cutting interest rates. However, these measures have not yet sparked the level of consumer spending and investment needed to reverse the trend. The challenge lies in rebuilding confidence in both businesses and consumers, who remain cautious despite the government's efforts to make borrowing cheaper and financial markets more accessible. Moreover, China's deflationary tendencies are being compounded by global economic factors. The slowdown in international trade, exacerbated by trade tensions and supply chain disruptio, This, in turn, has limited the country's ability to generate inflation through rising export prices. In this deflationary environment, businesses face increasing pressure to reduce costs, which often leads to lower wages and job cuts, further dampening consumer spending power. The global impact of deflation in China cannot be understated. As the world's second-largest economy, China's deflationary pressures could have ripple effects across global markets. For commodity exporting countries, reduced demand from China means lower prices for goods like oil, metals, and agricultural products. Additionally, weaker Chinese demand for foreign goods could hurt global supply chains, leading to broader deflationary trends worldwide. For China to regain its economic footing, it must find a way to stimulate demand without further eroding consumer confidence. Chapter 6: Impact on the Global and U.S. Economy. China's economic slowdown is reverberating across global markets, with the United States and other major economies feeling the ripple effects. As the world's second-largest economy, China plays a pivotal role in global trade, manufacturing, and investment. When China slows down, it sends shockwaves through industries worldwide, affecting everything from commodity prices to consumer electronics. The interconnected nature of today's global economy means that a downturn in China can lead to disruptions in supply chains, reduced demand for exports, and heightened market volatility. One of the key areas where the U.S. is feeling the impact is in the technology sector. Many American companies rely on China not only for manufacturing, but also as a significant market for their products. The slowdown in Chinese consumer spending, driven by economic uncertainty and deflationary pressures, has led to reduced demand for U.S. goods, particularly electronics, automobiles, and luxury items. Tech giants like Apple and Tesla, which have a strong presence in China, are seeing slower sales growth as Chinese consumers tighten their wallets. In addition to tech, the energy sector is feeling the strain. China is one of the world's largest importers of oil, and as its industrial output slows, so too does its demand for energy. This has led to a decrease in global oil prices, impacting U.S. energy companies, particularly those involved in shale oil production. With reduced demand from China, global oil prices are under pressure, which could affect the profitability of U.S. energy firms and the broader energy market. Supply chain disruptions are another consequence of China's slowdown that is hitting the economy. Many American manufacturers depend on Chinese factories for components and finished goods. As China's manufacturing sector faces declining orders and production slowdowns, the global supply chain is being strained. This leads to delays, higher production costs, and in some cases, shortages of critical materials and products in the U.S. market. From electronics to pharmaceuticals, many industries are grappling with these challenges, which are likely to persist as long as China's economy. Financial markets are also reacting to the uncertainty surrounding China's future. Investors worldwide are closely watching China's economic trajectory, and fears of a prolonged slowdown have contributed to increased market volatility. In the U.S., stock markets have experienced fluctuations as concerns about China's economic health weigh on investor sentiment. Additionally, the potential for weaker global demand due to China's slowdown is putting pressure on multinational corporations. On a broader scale, the Chinese slowdown could lead to a global shift in trade dynamics. With China consuming less of the world's commodities and manufacturing fewer goods, other emerging markets might step in to fill the gap. However, this transition will take time, and in the short term, the global economy is likely to feel the strain of reduced Chinese demand. For the U.S., this could mean slower growth in key sectors and heightened uncertainty in international trade relations. Conclusion: the global stakes of China's recovery. As China navigates this critical moment, the implications of its success or failure will be felt far beyond its borders. Whether it's through declining demand for global commodities, disruptions in supply chains, or volatility in financial markets, the entire world has a vested interest in China's economic trajectory. The stakes are especially high for industries like technology and energy, which are deeply intertwined with the Chinese economy. Ultimately, while the stimulus package offers hope, it's clear that there are no easy fixes to the structural issues plaguing China's economy. As the world watches, the outcome of this bold economic gamble could shape the future of global markets for years to come.